So I thought we'd spend today just going through the markets, looking at what's happening in the S&P and what's been happening in some of the other indices and some of the things I'm watching. Also, I wanted to just touch base with, just go over some of the economic data that we're going to be getting. I thought we'd just start off really quickly with this advanced good trade balance. This came in much lower than expected, and this was because imports were down. And so this is important because we actually got a really big boost in GDP now. So those negative GDP prints that we got in the first quarter probably were mostly negatively impacted by the front running of the tariffs, the import side of the equation. And if that is the case, then you could see a meaningful boost in second quarter GDP if it is the case that these imports are now coming down. That's important to keep in mind because I know, there's been some recession concerns, lingering out there. I'm sort of more in that slowing growth, elevated inflation camp, but I'm not really in the recession camp, and I haven't been in it now for some time. This week is also going to be very important because we're going to be getting ISM. We're looking for 49.5 versus 48.7 on the manufacturing. We're going to be getting JOLTS. That's expected to continue to come down to 7.1 million. ADP's employment's expected to increase to 115,000 from 62,000. ISM services is expected to increase to 52 from 51.6. Continuing claims, initial claims, everyone's been paying a little bit more attention to these. They have been creeping higher. They're certainly not at alarming levels yet, but something to keep an eye on. Certainly if the trend keeps going higher, although they've been mostly getting revised down as well. Non-farm payroll expected to be decent, 130,000 down from 177,000. Unemployment rate expected to remain unchanged at 4.2%. Average hourly earnings expected to rise by 0.3. Year over year, 3.7. So these aren't, certainly none of these numbers are recessionary. And in some of the cases, there's expected to be some improvement. I'd be watching very closely, though, the prices paid indexes for both the services and the manufacturing sector, just because those have been showing a pretty meaningful uptick on some of the regional Fed surveys. And so that's something that obviously could be a little bit of a hiccup for the markets if we do get that. When we look at the broader markets, before we get into the S&P, I just wanted to touch on the 10-year. Again, if we're going to start getting better economic data, it certainly would argue for a higher interest rate environment. Certainly, I know a lot of people keep thinking that rates are going to come down, and so far to this point, we really haven't seen that. Now, most of the curve steepening we've been seeing is really far out at the 30-year. And again, what I would kind of think is that there's a good case to think that if the data continues to come in as it's been coming in, you can potentially see interest rates continue to rise. I think one thing we could look at is this city surprise index, which is in blue. And that's actually been increasing now for a little bit. And historically, when you look at the city surprise index versus interest rates, it would seem as if, the city surprise index tends to be a bit of a leading indicator towards where interest rates are going. And so if that is the case, and we're going to continue to see better than expected economic data, it could very well be the case that you're going to see interest rates continue to rise, and certainly we've been seeing that, right? We've been seeing the 30-year rate rising versus the curve there has steepened materially, and really right now we're kind of consolidating at the 60 basis point region, and obviously it's been a pretty tough area for the 30-year to kind of break through. But again, I think there's a good chance that we're going to do that, and once we do, I think you could really see that really steepen out quite materially. And I think it really just comes back to some of the basics, which go back to last week we spoke about, is that if the Fed funds rate is going to bottom out somewhere around 3.25% to 3.3%, like the market's anticipating, then the 30-year rate deserves to trade at a higher premium. You can see on this chart that the Fed funds rate's expected to come down over the next couple of quarters to around 3.2% in 2026. But what's really important here is that spread, which is the 30-year minus the Fed funds and the 10-year minus the Fed funds. Right now, I mean, they're not really getting much of a premium to that. And when you go back and you look historically, when the Fed funds rate comes down and ultimately bottoms, you usually see some form of a peak in that 30-year minus the Fed funds rate, and it's usually coming on the 30-year around 3.5% to 4%, and on the 10-year around 3%. So I mean, you're talking about a 10-year, if the Fed funds rate is going to bottom out somewhere around 3.2%, you might expect that at 300 to 400 basis points above, you should be looking at a 10-year in the sixes and a 30-year maybe approaching sevens. And I know those are really high numbers, but unless we're going to really start seeing economic data deteriorate, and unless we're really going to start seeing the Fed funds rate expectations really start coming down, it's hard to understand why they shouldn't be trading higher, in my point of view. And I think that's really something that's underappreciated by the market. And I think, for the most part, you can see that kind of in the MOVE index, which has been the volatility index for bonds, and that's really come back down to the lower end of the range. And so, it's quite possible here that we get some sort of spike in volatility in bonds, and we're going to potentially really start seeing rates on the back of the curve, more importantly, break out of this trading range they've been in since, October of 23. And it's something we'll have to just keep very close attention to. When we look at the S&P, again, I've been kind of, fooling around in the blog talking about the potential setup here. Again, I go out on a limb and I kind of put my neck out on the line when I make sort of these calls, which are sort of out there, right, or bold. But look, I'm just looking at the chart and I'm trying to present to you the information that I'm seeing. And so what I see here is on the S&P 500 futures, this was obviously that day when the tariff news came out about the court, and this was obviously the previous highs. And so what you have here is potentially a classic 2B top. It's called a Trader Vic 2B top, and that's typically when you have a high like you did in this case. Here was your closing price. And then what happened was that we tried to break out above that high with the candle, and then we came back down and closed below it, and that would typically be called a Trader Vic 2B top, or potential reversal pattern, and that would suggest again that we should really be seeing some sort of high put in here and a reversal back down. Again, I'm sort of been looking for this gap to fill it at the May 12th region and around 56.60 or so on the cash market. And again, it's not very often that you see futures with big gaps like the ones we've had, and that could even call for something lower, but we're not going to worry about that yet because we still need to first break below this 5,700 area. And so even from a more traditional sense, you can certainly make the case that we are forming on this chart at least even a classic head and shoulders, with this being the neckline around that area. And this would also suggest that if we were to get a break of this neckline, let's say, it would suggest a move back down into this 56.50 area. There's some other things that I'm seeing here as well. This was obviously your OpX dates. Here was OpX for May. Now, again, we haven't really seen a pullback yet, but we've certainly seen a pause. This has certainly led to a pause of the recent rally. I mean, you could make an argument, I guess, that maybe this started to trend down, and now you're just reversing some of that trend and coming back up, and now you're going to start making another leg down. Here you can also see, when you look at the cash market and you look a little bit closer, you have what looks like the potential here for some sort of head and shoulders type pattern. Notice that the cash market never got nearly as high as on the futures market, which is usually odd. Obviously, we didn't see the cash market trade that high, and so you could be having what forms looks like, again, a head and shoulders type pattern. You could have what looks like, a diamond pattern that's been forming here. And again, that would also call for, a breakdown to around this gap fill, and potentially even further than that. Again, obviously, I think what's nice about these patterns is that they're easily identifiable when invalidated, and if invalidated, you would just have to really take out this high at 59.70 for that to happen, and you would no longer be the case. It would no longer be a working pattern. Additionally, we have this potential rising wedge pattern here, which again, too early to say whether or not this is going to fail or work. But, again, easy way to invalidate it would just be taking out this high, because we really shouldn't at this point be seeing that. We should really be starting to see a meaningful breakdown. Also, here's your downtrend. You can see that here, and that would also suggest that a break above this, 59.70 area would invalidate that as well. So what this is kind of showing us is that this area has the potential for some sort of top and a reversal that could bring us back to at least this gap area at 56.70 or so, at least on the S&P cash. And when you look at the Dow, it's got a similar sort of setup. Notice the 200-day moving average has really been acting as resistance. It also looks like there's potential here for a diamond pattern, a head and shoulders type pattern. And even when you look at the RSP, that pattern is also somewhat present as well. And again, the 200-day moving averages have been acting as a magnet, as a little bit of resistance as well, for which is the equal weight S&P 500 ETF. Some of the other things that we track here in the marketplace, we've seen the BTIC contracts really not do much of anything. Historically, we like to see confirmation of a rally in the marketplace confirmed by changes in the equity financing costs. And again, we haven't really seen that during, this rally. We had those confirmation periods quite often, with the market really going in the same direction as equity financing costs. In this period of time, you really haven't seen that. This move higher has come really late. And so I would have preferred to have seen that rally starting sooner. But again, at this point, this really isn't giving me a lot of confidence. This still looks a lot more like this period of time where you were getting these rallies in the market while this continued to go lower, and it really wasn't paying attention to any of it at all. And it wasn't really until you got into this period of time that you started to see that change in a meaningful way. So this is also kind of suggesting that we're still not convinced that there's something really more material going on here. The SMH, here you can see we came down from this high to this low. This is the 78.6% retracement level. When we look at the 200-day moving average, we can also see that we've been flirting with this level. This has clearly been acting as support. Again, if you want to play, with the patterns here, you can certainly do that. Here is your potential for a double top pattern with your gap opening here, potentially signaling a decline back into the 220s. And of course, I think, so what again, this is kind of pointing to is this idea that, this could also be an area where you see some sort of a turn in the semis, which has really been an important leading indicator. Here you can see the break of the trend line come back, and you retest the trend line, hasn't been able to successfully get through it. And then finally, we'll just finish off with a couple of FX. Here's your Japanese yen. Clearly, the Japanese yen big move up here following that announcement around the tariffs with the blocking of the court. Clearly, we hit the trend line, failed to get through it. Now we're going to probably be looking to move back down towards this 142 area. The euro also mostly trending higher here, again, sort of signaling that maybe the dollar continues to weaken. We haven't really seen a meaningful reversal of this trend yet. And then finally, I think the Taiwan dollar is really interesting because, again, this is important just because of what's been taking place with tariffs, with the repatriation of money outside of the U.S., and certainly we've seen the Taiwan dollar strengthen materially versus the U.S. dollar. And again, this kind of, I think, serves as a sentiment gauge in terms of the direction of what the market is thinking about in terms of tariffs in particular. And I think right now the market is still worried about where tariffs are and how they're going to have the impact on trade. Anyway, I hope this was helpful, a little bit different, but I hope you enjoyed it. Please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again, hopefully during the middle of the week. Bye.